Welcome. Today we're diving into the world of business acquisitions. Whether you're an entrepreneur, an investor, or just curious about how major companies grow through acquisitions, you're in the right place. I'm excited to walk you through the essentials of analyzing acquisition deals, helping you understand what's at stake and how to make smarter business decisions. Let's start with a quick roadmap of what we'll cover. First, we'll lay out why analysis is so critical in acquisitions, then discuss the main objectives you should keep in mind. Next, we'll explore how to value a business, walk through key steps in due diligence, and talk about assessing strategic fit. We'll also examine a real-world example to see these concepts in action, highlight common mistakes, and wrap up with best practices. By the end, you'll have a solid framework to approach any M&A deal with confidence. When it comes to buying a business, careful analysis isn't just helpful. It's essential. Jumping into a deal without doing your homework can lead to overpaying, messy integrations, or missed opportunities. Think of analysis as your safeguard. It helps ensure the deal aligns with your goals, reduces risks, and maximizes your potential returns. A systematic, step-by-step approach puts you on the path to sustainable growth and smarter investments. In short, solid analysis is truly the foundation of acquisition success. Business acquisitions aren't just about buying the biggest or most profitable company you can find. A good evaluation helps you grow, generate value, and keep risks in check. There are 4 main things you need to focus on. Identify strategic fit. Look for how the target company fits with what you already do well and how it can support where you want to go in the future. Mitigate risks early. This means really digging into financial health, the competition, legal concerns, and operational connections. It's about spotting issues and addressing them up front. Maximize potential value. Analyze the numbers, study the customer base, and identify hidden synergies. Those are places where merging operations create extra value. Enable informed decisions. With this foundation, you're making decisions based not on hope, but on real information and thoughtful analysis. Let's drill down on the key objectives of analyzing business deals. The heart of every acquisition is valuation, figuring out what the business is truly worth. You'll need to compare different methods like looking at future cash flows, evaluating against similar businesses, and summing up tangible assets. The goal isn't just to find a number, but to really dig into what's creating value so you know you're paying the right price and structuring the deal smartly. There are 3 core approaches you'll want in your toolkit. Discounted cash flow. DCF. This method projects future earnings and brings them back to today's value, which works best when you can trust those forecasts, like with steady, cash-generating companies. Market multiples, comparables here. You compare the target to similar companies that have sold recently or are publicly traded. Think of it like checking the going rate for houses in the same neighborhood. Asset-based valuation. This adds up all the company's assets, subtracts what it owes, and is especially useful for businesses where assets, like equipment or property, drive most of the value. Each method has its place, and combining insights from all 3 gives you the strongest valuation. Every valuation hinges on having accurate data. That means you'll need statement review. Start with audited financials, examining revenue, profits, and asset strength over several years. Projections. Management will share forecasts, but don't take them at face value. Test their assumptions and see how results compare to others in the industry. Quality of data. Ideally, you'll get your numbers independently verified, especially for bigger deals. This protects you from misstatements or errors that could affect your offer price. Being thorough upfront saves you from costly surprises later. Now, let's talk about due diligence. The deep dive that uncovers hidden risks and ensures the deal holds up under scrutiny. Focus on finance. Double-check revenue, recurring income, profit margins, and balance sheet health. Confirm the cash position and look for hidden liabilities. Structure. Review how the business is owned, any subsidiary agreements, and legal obligations. Watch out for ongoing disputes or litigation. Growth. Study the customer base and market position. Are there opportunities for expansion or significant barriers? Alerts. Red flags include declining sales, undisclosed liabilities, outdated intellectual property, or customer losses. Be wary of projections that seem too optimistic without real backup. Here are some hands-on tips for making due diligence count. Customer churn. Examine how many customers the company loses and whether it relies too much on a few big clients. High churn and customer concentration amps up your risk. Legal issues. Always have legal experts check contracts, intellectual property, and compliance. Regulatory problems or ongoing lawsuits can seriously derail a deal. Growth opportunities. Also, don't just look for problems. Hunt for hidden strengths. Could the company enter a new market, launch a product, or streamline operations to boost future value? Success in acquisitions isn't just about numbers, it's about the strategic and cultural match between the buyer and the target. What should you be looking for? Cultural fit. Assess whether the leadership styles, decision-making processes, and employee values mesh or clash. Large differences can lead to tough integrations. Synergies. Look for tangible ways the two businesses can create extra value together through cost-cutting, higher sales, or grabbing market share. But be realistic, back up your synergy estimates with data and scenario analysis. Long-term fit. Make sure the deal supports your broader business goals. Chasing opportunities that don't align can distract and drain resources. Let's bring these ideas to life with a practical example. Imagine a tech company eyeing a SaaS competitor. Here's how they approached the deal. They started by using DCF and market multiples to get an initial value. Next, they independently checked management's projections, adjusting numbers to be more conservative. Due diligence focused on churn rates, contract quality, intellectual property, and the competitors' standing in the market. Cultural fit was strong, and they identified promising synergies. They could cross-sell to one another's customers and share technology. After a final legal review and addressing any lingering risks, the acquisition went through. The result? The combined company enjoyed scale, market reach, and shared data, which unlocked new value, accelerated growth, and set them up for a leadership position in the SaaS space. Having a step-by-step evaluation gave them control over value and risk at every turn. Finally, let's spotlight some common mistakes and the best practices to counter them. Ignoring hidden liabilities or trusting unverified projections can lead to disaster. Always use third-party validation. Overlooking cultural fit or integration risks is another pitfall. Get buy-in from leaders, check compatibility, and plan for integration from day one. Overpaying for uncertain growth is a trap. Make sure your valuation is balanced and based on real financials and market data. Neglecting customer churn or key risks can leave you exposed. Review customer contracts and concentrate on risk. The takeaway? Combine systematic valuation with a deep risk and opportunity assessment for better decisions. We want to hear from you. Share your deal stories, suggest topics for future videos, or drop any questions down in the comments. By building a community around smart acquisitions, we can help everyone make better deals, avoid pitfalls, and maximize value. And, of course, don't forget to stay engaged and subscribe. The next topic on M&A analysis or business valuation could be exactly what you need. Thanks so much for watching. If you enjoyed this video, don't forget to hit that like button, subscribe to the channel, and tap the notification bell so you never miss a new upload. Your support really helps the channel grow. See you in the next one.